Good afternoon, everybody. The clock has ticked round to 2 o'clock, so that means it's time to start. So welcome, everybody. My name is Desmond Gardner. I'm from the EIB's team working on Fee Compass. I'm very pleased to welcome you to this second online webinar on the topic of audit of financial instruments in the 2021-2027 programming period. We had more than 500 people at the first webinar on this topic that we held in March, and during that session we had more than 100 questions on different aspects of the new methodology and audit of financial instruments generally. Although we were able to answer some of those questions on the day, we thought to do it justice, we should organise this second follow-up event where we could really answer all the questions that were raised. So I'm very pleased to welcome you today to this event. I will say that we will record today's event and also publish the slides that we're going to use today, which you will see have written responses to the questions you've raised. So I think they will be a valuable resource for you as practitioners, both now and into the future. And it will be one of several resources that we've published on the Fee Compass website. As you may know, we have a new improved search engine on the website. If you type Audit into the Fee Compass website, you get now several new and recent publications, all related to this topic, including the methodology and the annex itself, the Knowledge Hub note that we did on this topic, podcast, and of course links to this and the last event as well. So hopefully that will be a comprehensive suite of documents that will help guide you through this topic as you manage your financial instruments over the next few years. I will introduce the panel in just one moment, but let me take you through the format. We've grouped the questions that we received into broad topics that largely follow the structure of the last event. We will go through it topic by topic. I will ask and the panel will answer each question in turn. Answering 100 questions in 2 hours is a challenge, as I'm sure you will appreciate. So we don't plan to take any further questions today. However, if anybody wants to clarify any of the answers given today, then please use the chat in the WebEx to raise your clarifications. And what we will do is try and pick up and clarify the point in the final version of the slides that we will publish. Okay, so without further ado, I'd like to introduce the panel. So we have today Axel Badrachani, the head of DG Regio's Audit Unit C2 from the European Commission, and his colleagues Dana Grecianu and Natasha Pra, also from the Audit Unit, and Oana Dordan, the Deputy Head of the Financial Instruments and International Financial Institutions Relations Unit at DG Regio, and her colleagues Radka Konstantinova and Eva Zalite. So welcome to you all. Very pleased to have you here today. We will also be joined by Jonathan Dennis, the head of the Financial Instruments Unit at DG Regio, in a few minutes. He will be a few minutes late, but he'll be able to join for some closing comments at the end. Okay, time is short, so I propose we move to the first question. So if we can have the next slide, please. And I think the first questions, Axel, are for you. So maybe we've put the link there for where the methodology can be found for practitioners. So maybe we can move straight to the second question. So question to you, Axel, does the methodology also apply to the previous programming period since the methodology has shifted significantly?
Well, no, it applies only for the 21-27 period due to the main changes we had in the regulation. So it's not relevant for the previous period.
Thank you. And a similar question, does the methodology apply to funding under RRF and NRRP?
No, it only applies to cohesion policy.
Yeah, and what about then EAFRD? Is it applicable for the agri work? Will COM use the same methodology?
Well, the methodology is really only for cohesion policy. Of course, the auditors for the other commission services could use this as a reference, but it applies only for us auditors for cohesion policy. And we expect the auditors in the member state auditing financial instrument also to use our methodology under cohesion policy.
That's great. Thank you. Thank you, Axel, and welcome. I should welcome all the speakers.
Thank you.
Sorry. Thank you. Thank you for your support. I think the next question, Oana, I think you're going to answer. So welcome, Oana. Hello, nice to see you as well. And what are the main differences compared with the previous audit methodology for the 14-20 period?
Good afternoon, everybody. Thank you, Desmond. So there are some major changes which have an impact on audit. So the first one is the regulation change, and we speak about the use for intended purpose will have to be checked as ex-ante, so when it is granted and not exposed. We have no more tranches, and we'll see later how this will impact the audit and the sampling. So the member states will have a first tranche of 30%, and after they will submit the incurred expenditure. And other changes are linked to the fact that the ex-ante is easier and reduced, that we can continue financial instruments during several programming periods, and we can combine the grant with the financial instrument easier under the financial instruments rules, and the management costs and fees have simplified rules and are performance-based.
That's great. Thank you, Oana. Please, could we have the next slide, please? And I think, Axel, maybe hand back to you. What is meant by single audit? Can we rely on the verifications by the managing authority?
Thank you, Des. So single audit, we have the article in the regulation, Article 80. The idea is not that the audit authority would rely on the verification of the managing authority, but rather that it should use the controls which were made by the body below. So first, as an auditor, you have to see what the MA has checked. You reperform. If it is fine for you, you can use this for your audits of operation. It gives you the assurance you need. The purpose is to try to reduce the administrative burden on the final recipients. So we don't want to duplicate the audits and the controls at the final recipient on the expenditure declared by the final recipient to the Commission.
Yeah, great, thank you. And linked to that, to what extent should the provisions of the methodology be encompassed in the management control system set up by the member states?
Well, it should be, I think it's important for the auditees, potential auditees, to know how they will be audited. So I would invite the managing authority and even a beneficiary of a body implementing a financial instrument to see what we are using or what type of tests we are, what type of controls we are looking into. It gives the expectation, the legitimate expectation on what we are going to check.
Yeah, indeed, makes sense. Thank you. And can we have the next question, please? I think Dana, maybe come to you for the first time. So hello and welcome, Dana, today. So can the audit authority or managing authority controls exceed the limits of the CPR, for example, by requesting visits to final recipients?
So the answer is straightforward, no. So no audits and no management verifications can be performed at the final recipient. Nevertheless, the bodies implementing the financial instruments are supposed to monitor the final recipients in accordance with their normal banking practice, and of course in accordance with the provisions in the funding agreement that are supposed to be in line with the program requirements and the CPR requirements.
Indeed, thank you. That's a nice straight answer, no, to that question. So thank you, Dana. And the next question is the audit methodology for 14-20 had a very useful annex on the functions and responsibilities of each actor. Can we rely on that for 21-27?
Well, that annex can be used by analogy. we have to also take into consideration that some terminology has changed. For example, the fund of fund is now the body implementing the holding fund. So we have already in the current methodology for 21-27 in section 3, we have already the management and control framework, and there we explain the structure, we explain each entity that is involved in the implementation of the financial instruments. It's true that we do not provide exhaustive details about the organization and the functions, but that is already briefly explained in the CPR. So we consider that sufficient, given that there is already experience, past experience on that. So it can, the previous annex can be used by analogy, but of course to be adapted to the terminology in the CPR for 21-27.
That's great. No, thank you, Dana. And then the final question is about financial instruments are managed by the EIB. Question is, it is clear that no financial instrument audits are made at the level of the EIB, but should audit authorities audit expenditures of the financial instrument implemented by EIB through intermediaries at investment level? It's the CPR
Yes.
article.
Article 81 in the CPR is clear. So the both system audits and audit of operations shall be conducted at the level of bodies implementing financial instruments. So the auditors can go and visit and check these bodies implemented the financial instruments. So the banks below, in this case, the EIB.
Thank you. Great. So that concludes the initial questions that we had, and we move on to the topic now of audit and ex-ante assessment. So thank you all. And I think Radka, you're going to answer the first couple of questions. So welcome, Radka. Nice to see you. And the first question is about the audit and ex-ante assessment. Is, are there any requirements for the institution preparing the ex-ante evaluation?
Good afternoon to everyone online. Thank you, Desmond. Good afternoon to you as well. So the short answer is no, and I will elaborate a bit. Basically, Article 58.3 gives all the legal requirement for the ex-ante. It should be prepared under the responsibility of the managing authority. And there are no legal requirements in this Article 58.3 for the institution the institution which will prepare the ex-ante. So it could be the managing authority when it's in-house. It could be external body. It could be a national promotional institution, for example, and it could be also reused from previous periods. So it is the responsibility of the managing authority, and it is the basis for the design of the financial instrument. And the answer of the next question as well, that it could be also done in-house, as I already mentioned. So, but
yeah.
No, who should prepare this?
Yes, thank you. Yeah, so the ex-ante assessment may be done by the managing authority itself or by consultants as they wish. Brilliant. Thank you, Radka. Can we have the next slide, please? I think, Natasja, maybe welcome to you as well. Nice to see you today. So first question to you is, are the auditors allowed to put the methodology or the results of the ex-ante in question?
Yes, good afternoon as well from my side. Thank you very much for the question. No, the very brief answer is no. Auditors are not supposed to put the methodology and the results of this ex-ante assessment under the questions. Very briefly, they're supposed to check just 3 relevant points. First point is whether this ex-ante assessment does include everything what is needed, so what is defined as a minimum requirements in the CPR. Then they have to check whether this ex-ante assessment was performed before the managing authority makes the contribution, paid the contribution to the financial instruments, and whether the actual implementation is in compliance with what is stated in the ex-ante assessment. So this program contribution, the leverage effect estimation, the financial products, the target group, and so on. So if this is actually in compliance, what is on the spot and what is foreseen in the ex-ante assessment, and if this is not the case, the auditors usually would ask for the clarification and justifications if there are some discrepancies.
That's great, thank you. And the next question, we reproduced it as we received it. Is it that the auditors are not expected to reperform the ex-ante, or that they should not be doing it? And so that's something we've said a few times, that the auditors are not expected to reperform the ex-ante. Yeah, please, can you confirm that?
Yes, I can confirm, and this is very much related to the previous question, where I have described what the auditor is supposed to do or to check in relation to the ex-ante assessment. So no reperformance of the ex-ante assessment.
That's great. Thank you, Natasha. Appreciate that. Radka, let's come back to you. This is a question, I guess, about the implementation after the ex-ante. Is it possible to deviate from the, I think, ERDF rate recommended by the ex-ante assessment, I think, in the implemented financial instrument? Oh, hi, Radka. Sorry, we can't hear you at the moment.
No? Can you hear me now?
Yes, yes, we can.
Yes, thank you. Sorry about that. So deviations are possible and they are probable as the financial instrument changing over the time, and not only on the recommended rate, but also on other elements. So they have to be duly justified and documented. That is the main message to be taken away. So there is no need to reperform, to do again the ex-ante, but there should be an explanation and justification why the financial instrument in reality is different from the one which was proposed in the ex-ante.
That's great. Thank you, Radka. And yes, and I think that echoes that word justified is in, I think, it's taken from the methodology itself. And I think the next couple of questions are about how that works in practice. And the next question is a communication to the monitoring committee of the justification of the deviation of from the ex-ante assessment enough to ensure that the completeness is okay? So yeah, it's communication to the monitoring committee, one way to record that justification.
Yes, that in our opinion, that should be enough. That's a good way to record this this communication and to be well understood and acknowledged by everyone.
Thank you. And a similar question to one we had just before, is the update of an ex-ante assessment something that can be done by the managing authority in-house, I guess?
Yes, that could be done, yes.
That's great. No, thank you. Thank you, Radka. So that concludes the questions we had about the ex-ante assessment and audit. So let's move to implementation and selection and the funding agreement. And Dana, maybe I can come to you for this first question, which is, can you tell us where to find the checklist for the verification of the selection of the body implementing the financial instrument covered by Article 12? And I think this is a checklist which is mentioned in the audit methodology.
Yes, thank you, Desmond. Indeed, we refer to a checklist in the audit methodology, but you might remember what Axel has emphasized, that this audit methodology and the checklist, both of them, they have been designed for our auditors. So the checklist on public procurement it cannot be shared to the public, but well, we share with our audit authorities. So we share our checklist with our audit authorities, but cannot be made public. So this is the first aspect. Then a bit regarding this Article 12 and what the auditors would perform the verifications in that respect. So Article 59 in the CPR allows the managing authority to award directly contract for the implementation of financial instruments to a body that falls within the scope of this Article 12 in the Public Procurement Directive, meaning public contracts between entities within the public sector. And may being a public entity, it awards directly a contract to another public entity. Nevertheless, MA has to observe the conditions that are listed in this article before being able to award such a contract. Now, the auditors are supposed to verify whether the conditions that are listed in this article are met. Notably, for example, they will check whether the conditions for in-house award are complied with, if it is an in-house award, or the conditions for inter-administrative cooperation according to Article 12, paragraph 4 in the Public Procurement Directive are observed. We have a question in our checklist that is attached to the audit methodology, is a question number 11B. That addresses this aspect.
That's great. That's great. Thanks, Dana. Maybe you could have the next slide, please. And the next questions go to Radka. And it's about Article 7 from one of the delegated acts from the last programming period. Article 7 of Regulation 480/201/2014. Criteria for the selection of bodies implementing financial instruments does not exist anymore. Are these criteria, however, still applicable in the 21-27 programming period?
No, they are not, because this is regulation from 14/20. However, we think if the managing authority considers useful and necessary the example of those criteria, they can be still used for inspiration. But this regulation is.
That's great, thank you. And maybe the next question as well, should we include in the funding agreement both investment strategy and business plan? And if yes, what is the difference between them? Could you elaborate on that?
Yes, so both the investment strategy and the business plan, they are required if there is implementation directly by the managing authority, Article 59.1, or under the responsibility, Article 59.2 and 3. But then those two elements, they're required in Annex 10. And the difference is that in the investment strategy, it is more the orientation of the policy objective, which will financial instruments meet the purpose. They could contain the final recipients, the target final recipients, for example, the plant, if there is a plant combination to be implemented, while the business plan, it is more the way which will be the financial implemented, the financial instrument. It's more in practical terms. For example, it could contain also the leverage plan expected. So it is that is the difference between the both investment strategy and business plan, and they're both required.
That's great. Many thanks. And you've helpfully put a link in the slide, and we'll put this in the published version too. The Knowledge Hub note that we did on the topic of the funding agreement last year, which I think gives more information about that as well. So yeah, many thanks, Radka. And staying with you, should the differentiated treatment of investor be stated in the funding agreement investment strategy? And if so, in what way?
Yes. So the differentiated treatment, this is elaborated in Article 61. We put on the slide also what it means. It could be stated in the investment strategy or in the other parts of the funding agreement. Actually, in our view, it should be stated in the investment strategy, because it relates about using the public funds and the accountability, how we would like the observation of this differentiated treatment of investors. So we expect it to be part in the investment strategy. And from that point, the audit work will be to verify whether the use of differentiated treatment of investor is in line with the investment strategy. In the brackets, we have the reminder of what Article 61 says about the level of differentiated treatment of investors. The important is that also to retain that the assessment could not be provided by the body which benefits from the differentiated treatment. So this is the main message. In the audit methodology checklist, also there is a question that could be checked about Article 61. So it is part of the audit methodology questions, which could be verified by auditors during audit of the funding implementation.
Yeah, thank you, Radka. Yeah, no, so that's very clear, both in relation to the funding agreement and how it would be audited in the future as well. So thank you. Yeah, in the case, next question is about continuation, which is another novelty, as Oana pointed out. So in the case of continuation, if the body implementing a financial instrument was selected within public procurement rules, must the holding fund ensure that public procurement rules are respected for the modification of the contracts? And what happens when those rules are not respected?
Yeah, so in the continuation article, there is no derogation of the public procurement rules. And in case there is continuation, the funding agreement had to be updated before the end of the eligibility period. So in case of continuation, it depends whether the selection procedure foresees adding extra resources and to ensure the continuation. So if this is the case, if it allows for such adding extra resources, then they would not be needed any new procedure. Also, if it's proportionate to the initial funds, I would say, on the public procurement held initially, the resources which would be to be added. But if there is no such option and forecast, then the selection procedure has to be repeated. And we put also in brackets for reference Article 72.1 of the Public Procurement Directive defines the rules for the modifications of contracts.
Thank you, Radka. And again, I'm not going to say this after every answer, but there is also a fee compass knowledge hub on this topic as well. So both this and the funding agreement, if people are interested to know more, then I would encourage them to look that up. Okay, so the next question and the last one on this implementation section, I think goes to you, Natasha, and it's are auditors expected to verify the compliance with public procurement rules at the level of final recipients?
Well, really not on the level of the final recipients, but on the level of the body implementing financial instruments, because this body is beneficiary according to the CPR rules. So the compliance with the public procurement rules have to be checked only at the level of the beneficiary. So in our case, the body implementing the financial instrument, if of course this is applicable, but not on the lower level of the final recipients.
That's great. Thank you again. That's very clear. Okay, so that concludes the topic of implementation, selection, and the funding agreement. So let's move on to auditing and the body implementing the financial instrument. We had a lot of questions about this, including on management cost and fees, which we will come to shortly. But for the first question, maybe say welcome to Ieva. Hi, Ieva, nice to see you. So the first question to you is, should the audit authority also check if the interest rate agreed is received and the repayment by the final beneficiary is made and received?
Good afternoon, Desmond, and good afternoon to everybody. And thank you for all the questions. So if we speak about the resources returned, so how they should be managed, the terms and conditions of the funding agreement should be clear. So, so it means that when the auditors look into the issue of resources returned, they will see how the body implementing financial instrument is managing these resources returned, which are attributable to the funds, for example, attributable to ERDF, and whether they are accounted and recorded separately as common provisions regulation requires. So the management of the resources returned, the capital and the interest, is the task of the body implementing financial instrument, and they manage these resources returned according to the funding agreement. So what the auditors will verify is that the body implementing financial instrument actually applies all the controls and performs its tasks according to the funding agreement, and it is their business to ensure that the final recipient repays the loan, it repays the interest, and it's not the task of the audit authority to do these tasks.
That's great. No, thank you, Eva. Before we move on to the next question, I noticed we've had a few people who've joined us late. Very welcome. I hope this is proving to be helpful for you. Juan asked a question in the chat about could we give them the answers to the questions. So for those of you who've arrived late, I said it at the beginning, we will publish a final version of these slides with all the answers on the Fee Compass website in the next few days. So there's no need to take lots of photographs or anything like that. They will be published later as well. Okay, great. Thank you, Eva, for that question. I think the next question is maybe to you, Dana, and it's, are auditors entitled to check how the financial intermediary is monitoring the actual use of funds?
Well, like when I explained at the beginning, this was one of the changes introduced in 21-27 CPR. The fact that the focus now is not anymore on verification of the actual use of support, but rather on the verification of the intended use of the support. Nevertheless, we expect the bodies implementing financial instruments to continue applying the same standard of verifications when deploying program resources as when they do verifications for their own funds. Now, the funding agreement should normally clearly indicate the documentation that would be expected, would be needed in order to support the intended use for support, and to ensure in this way the audit trail as required by the provisions of the Annex 13 to the CPR. Then only if there are indications of irregularities or of fraud cases, only then additional verifications might be conducted. Otherwise, the verifications will be ex-ante, will remain ex-ante, so there will be just the focus on the intended use of support.
Many thanks, Dana, and we will come back to this topic a little bit later in this webinar as well, but thank you for that very clear response. Eva, if I can come back to you now, how should controls over bodies implementing financial instruments be implemented once there are no more tranches and financial instruments payments are made mainly as the loan is signed?
As Juana mentioned, indeed, this is a novelty in 21-27 programming period, that we no longer have tranches, but one advance and then reimbursement of expenditure based on the actual expenditure incurred. As before, the managing authority will agree in the funding agreement with a holding fund or specific fund, and if there is holding fund, then funding agreement between holding fund and specific fund. What are the monitoring arrangements between these legal entities? So the fact that there are no longer tranches does not affect the monitoring by the managing authority of the implementation of the funding agreement. So once the managing authority receives the payment claim from the beneficiary, for example, the holding fund, This payment claim will, in general, will be accompanied by a list of transactions. So the managing authority then will perform its administrative and on-the-spot verifications on the basis of the risk assessment that it has performed based on their assessment, and taking into account the monitoring arrangements which have been agreed in the funding. So the absence of tranches does not influence the usual work of the managing authority.
That's great. No, thank you, Yeva. Okay, can we have the next slide, please? The next question, I think, Radka, you will answer this one. So it's about unpaid loans. How will the actions of bodies implementing financial instruments, such as the holding and specific funds, in the collection of unpaid loans be verified? When can the specific fund end the collection of an unpaid loan? Do they have to continue to chase it to the end of the program?
Yes, thank you for the question. Yes, the recovery procedures of unpaid loans, they are part of any normal banking activity, and they are not in the scope. They are not regulated by the CPR. So normally, what we expect to have in the regarding rules of recovery, they could be agreed and should be agreed between the managing authority and the bodies which are implementing the financial instrument. And they should be part of the funding agreements.
Great, no, thank you. Thank you. That's very clear. And maybe, Radka, you can answer the next question as well, which is, can the body implementing the financial instrument outsource the closure of contract with final recipient to a subsidiary company?
Okay, thank you. So here we understood it that for us the question could have two meanings, and we developed on the two potential scenarios. So the first is if the question refers to the fact that one body implementing the financial instrument will transfer the portfolio, the management of the portfolio to is a subsidiary of its own for the closure, just the remaining period of the portfolio, then our answer is yes, it is possible if the managing authority is okay with this, agrees to this transfer. This is the first scenario. The second scenario is if we are in a situation of provision of factoring services or guarantees for such services by the financial instrument. And then we say, no, it is not eligible under the CPR rules. Because the factoring services for us, it is not allowed really with the purpose and the policy objectives of the financial instrument, because when we have factoring services, we don't support investments in new financial, final recipients. We cover in the factoring, we do not cover the risk of the SME, but we are more covering the risk of the factor, and this is not the purpose of the financial instruments in the policy in which we are. So we don't see the purpose of eligibility for those factoring services. And we also put on the slide as part of the answer Article 59(7) of the CPR, which we have to remind about the purpose that the final recipients, they have to receive support from the financial instrument according to the program objective. And also we remind of the potential of the financial viability of the investment justified in the business plan or for us, and when we are in factoring, this is not compliant to such financial viability, and also a selection of viable final recipients. So this is why we say that it is not eligible if we are talking about factoring.
Thank you, Radka. That was a very good answer, and as you say, yeah, there was more than one way to understand the question. So hopefully we've done it justice. That was a great answer. maybe I can move on to the next question, please, which is for Axel, I think, and it's on the topic of management costs and fees. The question is, could you elaborate on the reimbursement of management costs and fees on the basis of performance, and how the audit will check the criteria of performance-based under CPR 68.4 in the case of financial intermediaries selected via competitive tender?
Thank you, Des. So indeed, the CPR clearly states that management fees should be performance-based. Doesn't mean that it should be only performance-based. It means that it should include performance criteria. We expect the MA to agree with the implementing bodies, with the bodies implementing the financial instrument on this criteria. Depending, of course, on the scope of the financial instrument. The criteria usually are not the same for a loan instrument, an equity instrument, or a guarantee instrument. Then our practice doesn't, we haven't spotted cases during our audits where these criteria were not there. So our practice is rather that indeed we always saw performance criteria in the funding agreements. But in any case, the auditor will need to verify indeed that the performance fee structure includes performance criteria. One of them could be, the percentage of the funds which are delivered at final recipient level. This is clearly a performance criteria. If there is a tendering process, we expect that indeed the outcome is translated into the funding agreement, so that we don't have something different in the funding agreement than in what was agreed as part of the outcome of the tendering process. Then the methodology, the auditors will have to check that the methodology agreed in the funding agreement is correctly applied. And maybe something important as an eligibility criteria, the fund manager can be remunerated, has to be remunerated before the fees are declared to the Commission. So this is an important point to remind. But as I said, we haven't encountered irregularities related to this lately when we do our audits.
That's great. No, thank you, Axel. And Dana, maybe another question on management fees. It is, what is the difference between the audit trail for management fees and management costs, and how you justify this difference during an audit?
Yes, so thank you, Desmond. Now, management costs are linked to incurred expenditure. So meaning that the auditors will look on the calculations. So based on the management accounting to see how these costs were calculated. Now, management fees, like the name says, is about fees. So the verifications will be performed having as a reference the provisions in the funding agreements. For example, the auditors will check whether the correct percentage indicated in the funding agreement was applied and whether that percentage was applied to the correct basis. Then in case of direct award of contracts, Article 68, paragraph 4 in the CPR indicates certain percentages that has to be certain percentages that have to be complied with, and then the auditors will check whether those percentages have been correctly applied. Now, another aspect that the auditors will focus on will be that the management costs and fees were really paid. So this is also important to check whether they were incurred. But all these checks can be confirmed and can be performed actually only in the final accounting year, but because before there is no certainty on the final amounts. Only in the final accounting year, the auditors would really perform these verifications and could ascertain the eligibility or not of these management costs and fees.
That's really helpful. Thank you, Thank you, Donna. That's very clear. Great. So that completes this topic. And if I could just say thank you very much to the panel so far as well, because we're keeping very much to time, which is obviously going to be one of the big challenges. So we're doing very well. We're probably exactly on time, and I hope it's useful for everybody who's listening as well. And thank you once again to everybody for raising these questions, because as you can see, they're very interesting and really cover a wide range of different topics. So let's now move on to audit and the final recipient. And we had a few questions on that. I think the first question, Dana, I'm staying with you actually. It is, please clarify what is meant by final recipients are not part of audit. We've seen it as a standard practice to ask final recipients to submit, for example, account statements in equity. Would you like to respond to that?
Yeah, so, I wish to repeat a bit myself. So the CPR states clearly that both management verifications and audits have to be conducted at the level of bodies implementing financial instruments, so at the level of beneficiaries. This means that no verifications and audits can be conducted at the level of final recipients. But this does not mean that the final recipients should not provide the necessary documentation to these bodies implementing financial instruments or bodies delivering the underlying new loans, depending if we are talking about loans or guarantees. So documentation is expected from these final recipients together with their application for support. And all this documentation should follow the rules that are stated in Annex 13 to the CPR regarding the audit trail. So all the documentation, the minimum requirements for ensuring the audit trail are in this annex, and the necessary documentation has to be submitted by the final recipients and maintained at the level of beneficiaries, at the level of these bodies implementing financial instruments, because the auditors will go and will check these bodies and will expect that the necessary documentation according to this Annex 13 to the CPR is there present. And if we take the example of an equity instrument, indeed, the auditors would expect that financial statements are received from final recipients in order to perform the necessary verifications.
No, that's great. Thank you, Dana. And I'm sure everybody listening is familiar with Annex 13 of the CPR. And it's a very comprehensive list of the documentation required. And yeah, I think you've helpfully made the distinction between information that has to be provided by the final recipient and retained, but which is one thing, but then the audit process itself is then something different. So thank you for that. And then the next question also to you, Donna, when you say that final recipients should not be audited, do you mean the part that the audit authority audits, or also checks done by the managing authority?
So both management verifications is Article 81, paragraph 1 in the CPR, and audits Article 81, paragraph 3 in the CPR.
That's great. Thank you. Can we have the next question, please? I think the next question is on visibility. And actually, we've only had one clarificatory question in the chat, and it is on this topic. So thank you, Thomas, for the question. Yeah, so the question that's been raised is, how can the body implementing the financial instrument make sure, thanks to the contract, that the final recipient will execute the obligation of visibility? Eva, I think you're going to answer that question.
Yes, thank you very much. And indeed, the point of visibility is very important, and it's important that it's recognized also at the level of the final recipients. And as funding agreement template indicates, the body implementing financial instrument should ensure that in the financing agreement with the final recipient, the terms and conditions specifies that the final recipient should respect the requirements of Article 50. For example, if it's infrastructure, that the if it's of a certain total cost, that, for example, a billboard should be put in place. So this acknowledgement of the public support is important. We understand that maybe the regulatory requirement is not straightforward, but here, for example, we suggest a solution that the bodies implementing financial instrument could carry out the monitoring of those terms and conditions that are included in the financing agreement, for example, through receiving a picture from the final recipient that shows that this condition has been respected. So this is the ways that could be this requirement could be monitored.
Yeah, thank you, Yeva, and I think maybe we will clarify later the question, which is about where support's given to an SME that maybe has its offices internally in a building not visible to the public. How can they comply with that? But yeah, I don't know whether you want to say anything on that now, or perhaps we can come back to that question later.
Yeah, maybe we come back later together with we complete the reply in the final slides.
Yeah, great. Thank you. And staying with you, Eva, should the financial intermediaries also check public procurement procedures of public final recipients to avoid irregularities with financial instrument funding? I think we've had a similar question on that already.
No, in this situation, so it's not the task of the body implementing financial instrument to verify the public procurement procedure. Any final recipient that is receiving support from the public resources should respect the applicable rules. So this is the responsibility of the final recipients to be compliant.
That's great. Thank you, Eva. Okay, that covers the topic relating to final recipients, and I'd like to return now to something we've already touched on with a response Dana gave earlier, but is also one of the novelties of the new CPR, possibly the single most important from an audit perspective, this issue of verifying the eligibility of expenditure and the intended purpose. So I think, Oana, maybe I can ask you the first question, which is what is the difference between eligibility of the use for support for intended purpose, a prospective thing, and eligibility of investments, which was perhaps something that would be verified both ex ante and ex post?
Yes, so eligibility of investments is broader than eligibility of the use for intended purpose. So, for example, when we speak about eligibility of investments, we speak about the eligibility also of the final recipients, if there are some conditions on the eligibility areas, and also about the eligibility period. So it depends very much on what are the eligibility conditions which are defined in the funding agreement. And you mentioned Desmond ex post, but there are no controls ex post. So all both the controls are done when the support is granted. So in our jargon, let's say, we call it ex-ante. So ex-ante means before the investment is done, so when the support is granted.
That's great, thank you. And maybe I can ask you the next question as well, which is, in the case of an equity fund, how can the intended purpose be checked by a managing authority where there is no holding fund, for example? In the case of financial instruments for innovation, digitization, economic transformation, and also support to small and medium-sized businesses?
First, we have to define what is the intended purpose of an equity fund. Yeah. So if it is the investment into the company, or if there are some specific conditions attached to it. But under all the question, under all the sectors you are mentioning in your question, the verifications are done on the basis of the application from the final recipients, including the business plan or equivalent document. So all these controls are done on the basis of what the final recipient is asking for, and in relation to the conditions which are linked in the funding agreement.
Thank you. Yeah, and that takes us nicely to the next question as well, Oana, which I think you're also going to answer, which is, yeah, how can one audit intentions? And I guess that's really a question about what the evidence needs to be gathered in order to demonstrate the intended purpose. Against what? Is a self-declaration by the final beneficiary sufficient? Should we only use certificates when we verify eligibility, or should we use statements of the final recipient as sufficient?
I liked very much this question, how one can audit intentions. And for the ones of you going to a bank to ask for a loan, I doubt that it was based on intention, the accordance of the loan to you. So we are in an environment where we have to understand, because we receive a lot of questions about this use for intended purpose, but it's not a novelty for the EU funds in general. So I would like to underline that we are just aligning with the EU instruments done under InvestEU or EFSI in the past. So we have to understand that a financial instrument is not a grant, so it should not be audited as a grant. And the entire difference comes from this intended purpose, because the intended purpose of the financial instrument is to give access to finance. So the question is how we verify this. So of course, it will be based, as I said already, on the business plan or equivalent. And as you know, the banks are taking this quite seriously because they want to see their money back. So it's not an intention, but it's a legal obligation between the parties. So they engage themselves, they will do certain investments. Of course, banks are working, or other equity investors are working with financial statements of final recipients, and these are very good documents which can be used because in most of the cases they are verified by auditors, by external auditors. And of course, we are not derogating with our regulation from the normal practice of the bank. So if the bank has some procedures which they have to respect, the main purpose is that they use their own procedures when they are giving also EU funds. About the self-declarations, the reply is a little bit, it depends very much on the situation. So there can be cases where self-declarations are enough. However, for example, if we have to check that the final recipient is an SME, the self-declarations are not enough, and the banks or the managing authority should do a minimum control to ensure that the SME is really an SME, and we have extensive tools in our place to do these checks. I know they are not easy, but it can be done, or at least it can be shown that all the necessary efforts are done in this respect. And of course, when we speak about self-declarations, the managing authorities or the national audit authorities can take a sample and make some additional checks to ensure that the self-declarations are correct. But it depends very much on the type of the aspects we are verifying.
No, thank you, Oana. And this, as well as some of the earlier responses, shows how the audit methodology and the CPR is responding to the fact that we can rely on normal banking practice to some extent, and once we're interfacing with the final recipient. So that's really helpful, and hopefully that's useful for everybody listening. So I know this is an important question. Maybe we can move to the next question, which is a separate topic, but relates to a different requirement under the CPR. And the question is, how is it verified that the financed investments have not been fully executed at the date of the investment decision, as established in Article 58.2 of the CPR?
Yes. Regarding this question, our purpose in the CPR was to ensure that we are not refinancing existing investment. So on the other hand, the risk we consider is quite low, because it should be really justified to have an SME which goes to take a loan, which they will have to pay back for something they implemented already. So in this situation, as I said already, the business plan of the company asking for support will be scrutinized by the fund managers, and there we'll see how much is the overall investment, how much own funds are brought in, or other type of financing, and how much it remains to be financed. So the first element which would be to be analyzed will be the business plan or equivalent documents, and it will be also the appraisal process of the bank for the loan, as well as any third-party reports. We should not underestimate the appraisal process of the banks, because they have thorough internal processes and risk analysis, and they know very well the situation of each final recipient and for what the loan is taken. We mentioned also in our reply that the date of the investment decision in general precedes the actual signature. So the regulation refers to the date of the investment decision. So the signature of the loan is not necessarily the date when the decision was taken. For example, the final recipient could have received an email from the bank saying that we will allow you, we made the analysis and you are entitled to have the loan, and we will send the document after. And in the case of equity, of course, the investment decision precedes the investment from the equity fund. So it also be the same like for loans.
That's great. No, thank you, Joanna. Very clear. Maybe the next question. Move to the next question now, please, and ask Dana this. How can a financial intermediary or an auditor verify ex-ante that an investment will not be repaid by a grant? This is obviously about pre-financing, so yeah, how can that be verified ex-ante?
Well, now the general rule is that grants cannot be used to reimburse support received from financial instrument, and financial instruments cannot be used to pre-finance grants. Now, the way the question is formulated leads us to combinations. Now, it depends on the type of combination. So if we are talking about combinations in one operation where the financial instrument rules apply, then ex-ante, the verifications can be done based on the information received from the final recipient together with the payment application, and based on the investment decision. Now, ex post, the verifications can be done taking into account that separate accounts or records have to be maintained for both components, for financial instrument component and for the grant component. In case the combination is in two separate operations, so grants follow their own rules and financial instruments follow their own rules, so separate rules, then well, in that case, there is a risk, a more evident risk of double funding. And in that situation, it is first the responsibility of the managing authority to ensure that they have the necessary controls in place to prevent this double funding. And the auditors will also carefully address this risk of double funding in their verifications by looking first as a reference to the verifications, to the management verifications performed by managing authority. And again, not to forget about this requirement in the CPR that separate records have to be maintained for the two components, for financial instrument and grants. And this is very useful to ensure, at least to gain some assurance that there is no double funding.
Great, thank you. And we will come back to combination in a few minutes as well, as we have further questions on that topic. So thank you, Don, I appreciate that. Eva, a couple of questions for you now. The first is about outputs. So reporting the achievement of outputs, is it to be done upon the final investment decision, or should we wait upon completion of the project?
As concerns reporting on the outputs to which financial instruments contribute and investments by the final recipients. So here we align the logic of how we determine eligible expenditure for financial instruments. So it means that the reporting for the output indicators to which the financial instruments contribute should be done on the same basis, like when we disburse, for example, a loan to final recipient or give equity investment to the final recipient. So it means that the reporting on the achievements doesn't have to wait until the project is finished, until it's completed. So there is no link between the giving the loan, for example, to the final recipient and waiting to register the achieved output.
That's great. No, thank you. And then the next question I think is related to that. It's talking about how in grants there's experience of what is a failure to meet objectives and then established causal reasoning in expenditures. What about for financial instruments, given what you just said?
Yes, as I mentioned before, for financial instruments, we follow the financial instrument logic. For grants, indeed, we wait until the expenditure is incurred and then it's reimbursed, and then we wait for the project completion, and then we identify what are the outputs achieved. For financial instruments, we provide liquidity to the final recipient to carry out its investment. So at the point when there is a decision about to give a loan, for example, we know according to the application and the financing decision what this investment is going to achieve. So we know what are the outputs we expect. So at that point when the, for example, loan is disbursed to final recipient, we can already say that indeed we have assisted one final recipient, or we expect that a number of jobs, for example, will be delivered.
That's great, thank you. Yeah, but that's really very clear. So thank you for that. That deals with the topic of verifying eligibility of expenditure. So now let's move on to another of the novelties in the new programming period, well, to some extent anyway, which is about combination financial instruments. The scope to do this was expanded considerably under the CPR, as I'm sure everybody knows, and we've had some good questions, so thank you for that. And Eva, if I maybe come back to you to answer that first question, which is about one of the core requirements for combination in a single operation. So what will happen if the necessity to link the grant with the financial instrument is not adequate? Perhaps you can explain a little bit about that as
well. Indeed, when managing authority is setting up financial instrument and it wants to design instrument which is combining financial instrument and grant in one operation, so it should undertake analysis and to show that indeed this program support that will be provided in the form of grant is directly linked and necessary to the financial instrument. And through this analysis, the managing authority will show that this link exists. So the grant may be justified to cover, for example, financial viability gap. It can be intended to achieve certain policy objectives. As long as managing authority can show this justification of the need of the grant within the financial instrument, it is difficult to see how this link can be challenged by the by the auditors, for example. If indeed it turns out that the grant was used, is used for completely different purpose and it's not linked to the loan, of course, in that situation, the grant component will not be eligible. So we expect that the managing authorities indeed use resources wisely, and this justification is there, and the grant support is really helping and reinforcing the use of the financial instrument.
Yes, and I think, as it says there, the justification is at the level of the financial instrument itself, isn't it? Not at the level of individual investments. So I guess the logical justification is at that higher level as well, isn't it? Good, thank you for that, yeah. But maybe we can move to the next question, which is about the requirement that the grant is less than the investment. I think that symbol summarizes them. Is it applicable on a project level or on the level of the entire funding agreement? And then it goes on to ask, as long as per instrument grant is lower than the loan, can we have higher than average rebates for some final beneficiaries, as long as the average stays, they've put below 30%, even? So that's one situation, I guess. Would you like to answer that question?
Well, here, indeed, we come back to the main principle that the grant should be linked and necessary to the financial instrument, and it should be monitored at the level of the financial instrument and not at the individual investments. So for example, the level of the capital rebate and the conditions according to which the financing will be provided to the final recipient, it can be modulated at the level of each and individual investment. So as the question suggests, it is possible. The idea behind this instrument is that it possibly establishes an average percentage for the capital rebate, but at each and individual investment, it can be higher or lower than the average, as long as it is in line with the funding agreement and the terms and conditions of the financing agreement signed with the final recipient. So if the financing agreement sets out these criteria according to which the capital rebate will be activated, and as long as at the level of the financial instrument, this proportion of grant not exceeding the amount of investment supported by the financial product is observed, then in this situation, the financial instrument should be in line with the provisions of the regulation.
Thank you, Eva. Very clear. Can we have the next question as well, which I think relates to a holding fund type arrangement? So it's a similar question really about the requirement that the grant is lower than the investment mobilized. Is the 49% grant requirement calculated at the level of a single financial instrument or at the level of the holding fund / funding agreement, which may include several similar financial instruments?
Well, the monitoring of the proportion should be at the level of the funds. So the maximum possible level should not exceed the 50%. So we expect that the financial instruments are prudent and they probably will monitor this proportion lower than 50%. So we speak about the, in the regulation, we speak about the financial instrument, the fund. So the proportion should be monitored at the level of the fund and not at the level of the holding.
That's great. Thank you, Eva. Radka, maybe I can come to you to answer the next couple of questions. First one is, can the body implementing the financial instrument outsource decision of granting technical support to another entity, for example, to a business incubator? Is that possible?
Thank you very much for the question. Yes, we bear in mind that the body which is implementing the financial instrument is responsible for the grant part as well. Having this in mind, however, and it is perfectly normal that the expertise which lies of assessment about the grant, who is getting the grant component, could be sought outside of the body implementing the financial instrument through agreement, cooperation, and as it is given an example in the question title, in case of business incubators, for example, so financial instruments which are equity, in case of technology transfer assessment of proofs of concept, or for energy efficiency as well, which is really a narrow expertise. Which is seeked, so it is possible, yes.
That's great. No, thank you. I think there's some good examples of that in some places already as well. Yeah, next question. Should this is about capital rebate. Should the capital rebate cover both private and public part of the loan, or should it cover only private funding? That's the question.
Thank you very much. So we don't. It is. More natural and normal to consider that it is the public contribution of the loan that will be transformed into a grant as a capital rebate. It is unlikely to think that it could happen with a private investor which will agree to forego the payment of repayment of the loan. So in our view, it should be, and the monitoring should be done at the level of the public part of the loan, because after the activation of the capital rebate, we have this readjustment. So this breakdown between the loan and the grant. Which is to be updated after the activation. In our view, it should be done, and it should happen at the level of the public of the loan.
Thank you, Radka. Yeah. We have the next slide, please. So this is more questions about the capital rebate, and Eva, maybe I can come to you about this. So a project is entitled to a 30% rebate. Should we impose how the final recipient uses it? Should it be used only to repay a part of the loan?
So when the final recipient will apply for financing in its business plan and its loan application, it will describe the planned use of the support based on which later on the financing decision will be made, as my colleagues explained earlier. And the financing decision will include the criteria according to which, if and when fulfilled, the capital rebate will be triggered. So from the beginning, from the outset, the purpose of the loan and the conditions providing the capital rebate will be known. So, so if we speak about if we take an example, for example, here we put in the slide. So the investment, the financing that the final recipient will receive will be 100% loan, and it should be used. It's in its entirety. So the full amount of loan should be used for the purpose it was issued by the bank. So once the investment is carried out, the financial intermediary will verify that indeed, the final recipient has achieved the criteria that were agreed with the bank. That allows to trigger the capital rebate. So if these criteria are met, the capital rebate is triggered, and only then the 30% of the loan to be repaid will be written off. So part of the loan is transformed into a grant. So from the point of view of final recipient, it means that it no longer will have to repay 100% of the loan, it will repay only 70%. From the point of view of the financial intermediary, it will register in its accounts the write-off of the 30% of the loan. And in this situation, there is no other cash flow involved. So 100% loan from the beginning, fulfillment of certain criteria agreed with the final recipient in the financing agreement, which triggers a capital rebate, and respectively, the final recipient has to repay less if it has achieved the agreed criteria. In practice, we are not tracing accounting of the final recipient, providing the use of each euro of the rebate. So the adjustments that are made in the agreements are sufficient.
Thank you, Eva. So if we can have the next question, please, and if I can stay with you, Eva, how do we make compatible the principle that the financial instrument can't be used to finance the grants, and the capital rebate is only established ex post, by that triggering criteria you talked about before?
So with the provisions in the CPR, what we want to ensure is that we are not paying twice for the same expenditure with the EU resources. So what we expect to see is that the investment, the amount at the level of the investment, if it is combined from grant and financial instrument, does not exceed 100% of the investment cost. For the loan that is combined with the capital rebate, that financing to the final recipient, as I explained in the previous example, starts with 100% of the loan. So in this situation, the loan is not pre-financing the grant, but rather that grant, subject to fulfillment of certain criteria, it becomes a percentage of that loan that was disbursed. So only the remaining part of the loan is then repaid by the final recipient. So as I said before, there is no additional cash flow, say, that involved that would repay the loan. So a certain amount of the loan is transformed into a grant.
Indeed. Thank you, Eva. And I think this is confirmed by the next question, which is actually more of a statement than a question that came in during the last event. But is it fair to say that capital rebate is not double support, but it's changing the form of the same support, the same money?
Indeed, yes, as explained previously.
No, that's great. Thank you, Eva. If we can have the next slide, please. And I come to you, Radka, with the next question. The capital rebate will be provided after project completion, and this may happen after the end of the eligibility period. So how would the audit be performed?
Yes, thank you very much for the question. First, to make the statement that there will be no expected audits after the submission of the final accounts. As we already heard before today, the eligibility is established ex ante. and through also the support to be used for intended purpose. So there is a an arrangement between the managing authority and the body implementing the financial instrument, the funding agreement, which is taking care of this provision as well. And normally there is no reason that at the end of the eligibility period, this is part of their also normal practice, there is no reason to believe that at the end of the eligibility period, they will stop verifying the activation of the capital rebate. So also until the winding up of the financial instrument. So the financial intermediary, the bank, should continue to respect the conditions of the funding agreement.
That's great. Thank you, Radka. Oana, maybe I can ask you the next question, which is about guarantee financial instruments combined with an interest rate subsidy. So in a guarantee financial instrument with an interest rate subsidy in one operation, when should we make the verifications within the year?
It depends very much how the interest rate subsidy is structured in the financial product, if it is linked to each installment or if it is paid in one go and at the beginning or the end of the programming. We are recommending to pay in one go during the eligibility period, because if it is paid after the end of the eligibility period, it's not eligible anymore. So it depends what are the conditions which are in the loan agreement in order to do the verifications, but the limit, which is in the regulation of maximum 50% of grant, is to be done at the end of the eligibility period.
Thank you. That's great. And yeah, if we can have the next question. And Eva, a question for you. Regarding the requirement, the grant and financial should be in one agreement. Concerning a single fund, which is an equity fund, how will the grant be reflected in the funding agreement? Should it be as equity in the account of the specific fund, equity fund?
Well, just to reiterate, it's indeed important that for the combined support in a single financial instrument operation, the grant component should be covered by the same funding agreement as a financial product itself. So the funding agreement will reflect the purpose of the grant, the potential rate or the amount of the grant that is planned to be used, how it will be provided to the final recipients, and whether it will be given as a cash payment or it will be used for the benefit of the final recipients. So and also conditions about how this proportion, what we discussed earlier, will be monitored. So if the body implementing financial instrument intends to use this implementation option according to Article 59(2)(a), which speaks about the investment of the program resources into the capital of legal entity. Well, here in the total amount of program resources will appear in the capital equity side of the balance sheet of that legal entity. So in this case, the program support will not stop there. So it will, as the implementation starts, so this legal entity will do investments in final recipients. And the grant component will be then used depending on its purpose. So it could be technical support, it could be accelerator program for the benefit of the final recipients, or it could be grant capital grant necessary specifically for that final recipient before equity investment.
Thank you, Eva. And if I can stick with you for the next question, what does reimbursement of payment mean in the case of specific funds, which are equity funds, where there's no holding fund?
Yes, this is indeed probably it's a bit of situation of using different terminology and terminology of the CPR. So when we speak about the reimbursement by the Commission, it means that these are the amounts that are included in the payment application by the managing authority to the Commission. So where the financial instrument is an equity instrument in a single layer implementation option. So here, when the funding agreement is signed, so meaning that the program resources are committed in the funding agreement, then and certain amount of program resources depends on the arrangements, are paid to the financial instrument, then the managing authority can request up to 30% of the amount of program resources committed in the funding agreement to be reimbursed by the Commission according to the Article 92 and 93 of the CPR. And then the subsequent payments will follow based on the investments in final recipients, so actual expenditure incurred. So in these 2 points, we speak about the reimbursement of expenditure by the Commission. If we speak about the how the fund is replenished with additional resources, meaning to ensure that it can carry out investments and actually generate this eligible expenditure. So these will be the arrangements that the managing authority and the body implementing equity fund, they will agree in the funding agreement on the mechanism and the and how often such contribution to financial instrument will be made. It is also possible that the full amount is contributed from the outset, but so that there is liquidity from the start. But nevertheless, the reimbursement by the Commission will have to follow the rules that are explained in points 1 and 2.
That's very clear. Thank you. Yeah, that was very, very clear. Final question in relation to combination. I think Axel, you will take this question. Is about double support. How will double support be checked if we don't require invoices?
Thank you, Des. I think it's good that Eva has clarified a few slides before that a capital rebate is not a double support. I mean, this is important to keep in mind. And I think that I also explained a bit before also the checks that can be done ex-ante and exposed to see if a grant is not covering the same type of expenditure. So I would refer to these two previous questions. And here what you have to notice is that in the regulation we have foreseen some safeguarding measures in case of combination. And these safeguarding measures, they are listed here in the slide. The first one is to have a separate records that needs to be kept for each source of support. The second one is that the sum of all forms of combined support should not exceed of obviously the investment amount. And the fact that indeed grants cannot be used to reimburse financial instruments and vice versa. What we have foreseen also in the regulation is that in the funding agreement, there is a specific provision foreseeing that there should be a monitoring system put in place by the body implementing the financial instrument. And when we do our audits, or when the managing authority would also verify, they can verify that there is such a system to prevent this risk to occur.
That's great.
This would be it. I hope with all these questions on combination, we are not discouraging authorities to combine. The whole purpose of the CPR is to facilitate and to have more and more combination of grants and financial instrument into one instrument following the financial instrument rules.
And I think you're right. I was going to say the opposite. I was going to say that the fact that we got a lot of questions on this topic must show that people are seriously looking at it. So I'm hoping it's a good sign that
Yes,
it's working, because I think this is potentially, you know, a really powerful tool. I'm sure many managing authorities will use it successfully in the future. But great, thank you everybody for that. The good news is we're on our last lap, as it were. Now we've got about 25 minutes left, and we're on track to cover all the questions. Thank you for everybody who's still listening online, and I see we've had some more questions come in on the chat. As I say, we will try and include those in our final versions of the slides, and when we had a chance to look at them. The next topic we want to cover is methodology. And so maybe I can ask Natasja to answer the first question. Are there any recommendations for risk-based management verifications for managing authorities who are implementing financial instruments for the first time, so they don't have historical data or experience to base it on?
Yes, thanks. Maybe just to mention for the beginning that this is also the novelty, risk-based management verifications in the period 21-27. They are not specific for the financial instruments, but also for the grants. Before this risk-based was referred only to on-the-spot checks. So if the managing authority already have some experience in preparing the risk-based analysis for the on-the-spot checks, so they can use these experiences, of course. But anyhow, managing authority has to identify some potential risks which are relevant for the implementation of the financial instrument. What this criteria or this risk factor might be. For example, if we have a look in the system set up, if there are many actors involved and many organizations, this definitely contribute to the high level risk in comparison with a very simple system. So at the first stage, the managing authority is supposed to define these risk factors and criteria, and then making this risk assessment, they have to evaluate every single predefined risk factors or criteria with the aim to get a kind of a final risk assessment with which they will be able to prioritize what is more important or more risky and should be subject of the management verification. Maybe we can give here the advice to turn to the audit authority who definitely have the experience to design different type of risk assessment, or maybe even internal audit service if there is some internal audit service inside the managing authority. So they have a lot of knowledge how to design the methodology, but of course, content-wise, knowing the environment, this is on the side of the managing authority.
Thank you, Natasja. And maybe staying with methodology, if we could have the next slide, please. A question for Dana, which picks up on a topic which came up actually in the Knowledge Hub. So it is, we considered this in that note there as well. The question is, the audit focus aligns with the life cycle of a financial instrument. What is the best timing and scope for an audit to happen, as this cycle is long, but findings could be important? Isn't the audit taking place too late in the fund operation, making the audit miss its proactive goal to prevent irregularities and recoveries? Sorry, that's a repeat of the last question, isn't it? We move there. There we go. Yeah, Dana, in relation to that first question.
Yes, it's for me, right?
Yes, please.
Yes, sorry. No, yes, because the previous slide was just a continuation. It could not fit.
Yes, sorry, we should have moved it on while Natasha was speaking.
In our replies. So indeed, like you mentioned, Desmond, the best moment to conduct these system audits is at the beginning of the programming period, in order to use the results of these audits as a preventive tool to prevent eventual irregularities later on. So it's better to correct at the beginning than later, and could have financial implications. At the beginning, the financial impact remains limited.
That's great, thank you, Dana. And then the next question is about the verification of, I think that we final recipients by the managing authority and the audit authority. Is it only based on a risk analysis?
Yes, that's a bit a novelty in the CPR for 21-27. Article 74, paragraph 2 in the CPR is clear. So for the 21-27 programming period, the managing authority has to perform risk-based management verifications. So it's not an option. They are asked to do it. So they have to go for risk-based management verifications. They cannot anymore perform 100% management verifications, even if they would wish. They cannot normally do this because CPR, that they will breach the CPR rules that requires risk-based management verifications that should be proportionate to risks identified ex ante and in writing, meaning that there must be a risk analysis and has to be documented, and how the risks have been identified based on previous verifications, or if there are no previous verifications, if the system is new, then so how they have identified the risk to be taken into account in order to perform these risk-based management verifications. And again, we reiterate again that no management verifications should be conducted at the level of final recipients.
No, thank you, Dana. And that theme of risk-based management verifications, it's something that it flows through all of the recent discussions and documents and guidance that's been methodology that's been produced in relation to this topic. And yeah, you underline really there how the CPR requires that of managing authorities. So we should expect to see it become standard practice. Thank you. Linked to methodologies, at least in my mind, is the question of sampling. So, Natasha, maybe you can answer the first couple of questions on this. So the first question is, should the financial instruments be audited as a separate stratum?
No, there is not an obligation to treat or to form a separate stratum for the financial instruments, which means that they can be either in a separate stratum or it can be included in the overall population alongside with the other grant operations. Who has to decide upon this? Probably the audit authority who has to perform these audits. But it is really very nice to be aware what are the advantages and disadvantages in case if we are make a separate strata. In this case, the main advantage is if we are expecting some errors in this strata of financial instruments, that means that these errors would be projected or extrapolated just on the stratum of the financial instrument. So this is the main advantage. It will not be projected to the overall population. But of course, the main disadvantage is related to the quantity of work. If we are having more strata, that means for the audit authority, a little bit more audit efforts to be put into.
Thank you. And the next question, I guess, is linked to that.
Yes.
Would any error on a financial instrument therefore be extrapolated over the entire population? I guess if it was in that single stratum.
Yes, all the errors which are found in the financial instrument which is selected as a sample have to be projected or extrapolated to the population from which it is taken out. That means if there is, what I have already mentioned, if there is a separate strata for the financial instrument, it has to be projected just to this strata. But if it is in a common sample together with the grants, then it has to be extrapolated to the whole population.
That's great. Thank you, Natasha. Can we have the next slide, please? I think, Dana, you're going to answer these next couple of questions. So sampling stratification ultimately takes place at the level of the final recipients being supported via the intended purpose of the financial instrument. So what happens?
Well, sampling, including stratification, if any stratification will be applied, takes place at the level of the financial instrument and not at the level of final recipients. That's to make it clear. Then, of course, the auditors, once they select a financial instrument to be audited, then they will define a sampling unit. That can be an investment, loan, a guarantee, a payment application, and then they are going to select certain loans, guarantees linked to a certain financial instrument that is to be audited. Now, the auditors will also will take into account the conditions at the time the investment decision was taken, and will, of course, base those audit verifications on the audit trail that has to be maintained at the level of beneficiaries, the parties implementing the financial instrument.
Thank you, Dana. Very important. So again, you're emphasising no audit at the level of the final recipients, I think, in that response. So yeah, indeed. And the next question is, does the same treatment of errors apply? So if there's no irregularities, the holding fund can reuse ineligible transactions. Does the audit authority have to include such ineligible transaction into TPER? I will admit this is now straying into technical audit territory I'm not totally familiar with. So Dana, please do clarify the question as well, perhaps, if you can.
There are two aspects. Each time the auditors identify irregularities with financial impact, then all those irregularities have to be corrected. So the corrections are expected either through the account or through next payment applications. And of course, each time the auditors identify an irregularity with financial impact, those would impact on the error rates, the abbreviations there, the total error rate and the residual error rate that the auditors are calculated and report those to the Commission. This is the first aspect. So everything that is irregular with financial impact, independent of the recovery process, was recovered or not, the recovery process remains under the responsibility of the member state. So independent of that, the corrections have to be made immediately. Now, the second aspect is the reuse of the contributions for which an irregularity was identified. And for that, we have the Article 103 in the CPR that stipulates a derogation from the general rule that applies for grants. The general rule says for grants that in case you find an irregularity with financial impact, then that the contribution, the program contribution linked to that irregularity is cancelled. That's the general rule for grants. Now, for financial instrument, there are exceptions. And the exceptions are stated in the same article, in this Article 103, that concerns financial corrections. And, for example, in case there are individual irregularities identified at the level of final recipients or at the level of bodies implementing a specific fund, then those contributions, program contributions for which these irregularities were identified, can still be reused for other final recipients or for other bodies implementing a specific fund. But all the details are in this Article 103 or in the presentation that we made during the webinar. Now, in case there are systemic irregularities in all situations, those corrections will be net, meaning that there will be a cancellation in the program contribution.
Okay, that's great. Thank you, Donna. Very clear. Natasha, maybe I can come to you with the next question. Management costs are also part of the population, meaning that they could be selected as one of the 30 audits of operations within one accounting year. Is that correct?
Yes, this is correct. In case, of course, if the management costs are a separate sampling unit, because Dana has already mentioned that at the first stage, the audit authority have to define what is the sampling unit, and it can be a payment claim, it can be a claim for whatever, but if this is the management cost, then it can be selected and audited, of course.
That's great, thank you. And going back to a previous topic, was stratification of financial instruments obliged in 2014-2020?
No, it was not obliged. In 2014-2020, it was actually recommended, highly recommended, I have to say. Why? Because the treatment of financial instrument in period 2014-2020 was a little bit different. Why? Because there have been no real expenditure in the payment claim submitted to the Commission. This was just the advance payment, these tranches. And due to this fact that the real expenditure has appeared in a later stage, it was highly recommended to separate this into the separate strata. But this is afterwards, according to the ECHA recommendation, the error rate has been recalculated.
Great, no, thank you, Natasha. And the final question on sampling to you, Dana. To select the transactions to be audited, should we abandon the random selection method provided for in the GDPR for audit authorities and rely only on the managing authority's verifications?
Now, the rules for sampling, just to make it clear, the rules for sampling for financial instruments in 21-27 are the same like those for grants and are stipulated in the sampling regulation. So the same rule for financial instruments apply like for grants. And Natasha explained that the sampling can be done by audit authorities based on the entire population, grants and financial instruments all together. Now, audit authorities, it's a usual, it's a normal, usual accounting audit practice. So the auditors, when they define their sample, they have to define the sampling parameters, and for that they have to assess whether they can take assurance, they can rely on the managing authorities' verifications. So if the auditors consider that they can rely on the system, the control system put in place by the managing authority, based on their system audits or based on previous audit of operations, then of course the sampling parameters will be adjusted to those expectations. For example, the expected error rate will be low. If they can rely on managing authorities' controls, they know that the managing authority has in place a sound control system, then the expected error rate will be low. And because the expected error rate will be low, then the sample size will be reduced, will be smaller than if, for example, the expected error rate will be higher, due to the fact that the managing authorities' control system in place is not reliable. So you see, there is a direct link between the work, the intensity of the audit work, and the quality of the control system put in place by the managing authority. Now, audit authorities can also decide not to go at a lower level, at the level of bodies implementing financial instrument, if the sufficient information is available at the level of managing authorities. So in a way, they can rely on all the verifications, controls, and documentation that is in place at the level of managing authority. That can be the case. So in this way, this is an example, an exemplification of the application of single audit principle. So we stop at the higher level, the auditors will stop at the higher level, at MA level, if everything is there and if MA's control system in place is sound. So.
Great. Lovely, thank you, Donna. And I guess, hopefully publication of this methodology at this stage will help develop those sound systems as well. And we are running slightly short of time, panel, I'm afraid, so apologies for that, my fault. But as we move to these last couple of sections, if we can try and be as succinct as possible, that would be great. Can we have the next slide? It's on irregularities. Thank you. Yeah. First question, Oana. Will the overbooking still be possible to replace irregular expenditure in a financial instrument? Is it possible to set up the list of additional eligible investment to be used to replace irregularities identified in the final year if overbooking isn't possible?
So overbooking is not possible as it was not the case in 713 and 1420. Overbooking means that the member state can declare to the Commission more than the amount which is in the funding agreement. So this is not possible because of the legal provisions. But it is possible, as it was the case in the past, to have a buffer, so a list of additional eligible expenditure from which the irregularities can be replaced, but this time around only for the clearing of the advance in the last accounting year. Because as Natasha and Dana explained, the irregularity in the expenditure, because of there are no branches anymore, will have an impact on the error rates.
That's great. Thank you, Oana. Dana, come to you for the next one. In the case of financial instruments combined with grants, does any irregularity of the grant also lead to cancellation of part of the loan?
No. When there is an irregularity at the level of the grant, but the loan is regular and eligible, now it all depends a bit on at which moment this irregularity is detected, of course. But normally the Commission is not supposed to reimburse the loan part, but the grant is supposed to reimburse the loan part, but and not the grant part. Yeah. Or if the reimbursement already took place, then of course there would be the Commission would expect corrective measures from the member state. Now, in terms of recoveries, how this will be recovered, all these have to be indicated as provisions in the funding agreement.
Great, thank you. And maybe staying with you, Dana, just about how many irregular or ineligible support from previous FIs have been verified as non-eligible and recovered from audits? What is the error rate in financial instruments generally from 1420?
Now, in general, financial instruments operations are considered less risky than grants for the EU budget, and that's because of the repayable nature of the instruments and the fact that there are private actors are involved and that they use their professional standards when performing the verifications. That's the first aspect. Then the second aspect, this is proved by the results. In 1420, we observe very limited number of irregularities on financial instruments. Now, we have also to consider that this might have been the case because of the tranches. Because in 1420, the legality and regularity is supposed to be confirmed at closure. And before, just observing the ceilings for tranches, and each time there was an irregular loan or guarantee, it could be replaced based on the buffer that one mentioned if in general, I think in most of the cases that buffer existed. So then the irregular expenditure could be replaced because, again, in 1420, legality and regularity was supposed to be confirmed at closure. Now, in 2127, the situation might be, we will see, but might be a bit different because except the first advance, the advance, with the first payment application, the 30%, the rest, what will be declared to the Commission will be incurred expenditure. So everything that will be found to be, that will be found to be irregular will be, will impact, will have financial consequences. Except the 30%. So for the 30%, there is still a margin of maneuver that can be made, and the buffer can be constituted still for that 30%.
Thank you, Dana. We are approaching the end, but as we're recording this, I would like to continue to do justice to the questions. So if it's okay with the panel and people listening, I will try and wrap up maybe by 4:10, and I apologise for overrunning. Natasha, if I can come to you on the next question. In the case of irregularity at the level of final recipient and the corresponding amount is unrecoverable, what should be done?
Yes, this actually has already been answered, this question by Dana in some previous question. Well, it is not relevant if the irregularity is recoverable or unrecoverable. Anyhow, it has to be corrected, so either from the payment claim or directly from the accounts. But of course, it can be substituted if there are some extra other regular expenditure, they can be replaced with them.
That's great. And maybe staying with you just about this risk-based approach we've talked about. What is the risk-based approach used in preventing irregularities, and how capable are managing authorities to apply this approach to monitoring or audit?
Yes, of course. Well, we have to start from the objective of the risk-based approach, and this objective is to select or take out those transactions which are the most riskiest one. And the most riskiest one means actually that these are the one where there is a the highest probability that something will go wrong, or that we will be able to find some irregular expenditure. But anyhow, this is the main objective of the risk assessment, and these criteria have to be defined by the managing authority, knowing the business, either from previous experience, and as I have already mentioned, if there are no previous or historical data, the managing authority should ask the audit authority or should consult how to approach to design the overall methodology for being able to recognize the most riskiest transactions.
Yeah, that's good advice. Consult the audit authority. I think that's very helpful. Thank you, Natasha. Maybe we move on to now audit and the payment claims, the reimbursement that we were talking about earlier with the EOMA. Natasha, staying with you, the first payment application, the advance of the up to 30% programme contribution, does this mean 30% of the European funds, not 30% of the European funds plus national funds?
Actually, it means 30% of European fund and national fund, because according to the Article 92.2 says that the 30% of the total amount of program contributions committed to the financial instruments. So this comprises both.
Thank you. Very good, very clear. And Dana, maybe I can ask you to do the next question. Should the audit authority audit the clearance of the advance payment as a normal payment claim?
Well, we already explained this in our audit methodology. So the expenditure clearing the advance is not declared to the Commission. So because it is not declared to the Commission, it can never enter into the normal population and sampling performed by audit authorities. Nevertheless, by the end of the programming period, so somewhere in the last accounting year or close to the closure, then the auditors will have to, the auditors, I mean the audit authorities, auditors will have to perform some work in order to confirm the eligibility of this expenditure clearing the advance, a bit like what is now done, but for everything, confirming the eligibility for all tranches, the legality and regularity for all tranches. That will be done in 21-27 only for this advance of 30%. So we explain in our audit methodology a bit how we expect the audit authorities to approach this. And nevertheless, it's not for now. So it will be somewhere in the last accounting year. So there will be probably the Commission will issue additional guidance on that.
Thank you, Dana. And it is also discussed in the Knowledge Hub, I think, as well. So there's something on the note in that note as well, which might be interesting for people. If we could have the next question, please, which is also, I think, for you, Dana. How can we organise the verifications over beneficiary payments from the managing authority to be included in the information sent to COM? I think this is, as you said, eligible expenditure audited only means eligibility based on business plans or equivalent documents, since receipts are required. So I think this is about mixing a few issues around this, the new eligibility test, etc. Can you help clarify that?
The first part of the question regarding verifications to be performed by MA. So MA is expected to perform risk-based management verifications like we have already stated before. And they have to maintain an appropriate audit trail. So that's clear. Then the second part about the eligibility of the expenditure, then there are two aspects. When the auditors will check eligibility of the expenditure, they will look first at the general eligibility rules. And for example, they would look at the compliance with national rules, the compliance with the program requirements, the compliance with the provisions in the funding agreements. Then they will look at the eligibility of the final recipients. For example, if an SME is an SME or not, the SME status. Just an example. Then there will be, like one I mentioned before, there will be verifications, maybe depending on the eligibility rules, how they are defined in the program, or additional documents linked to that. For example, there might be eligibility areas, or there is an eligibility period. So there are certain general eligibility rules that have to be complied with, and the auditors will look at that. But the reference documents, so there will be, let's say, the funding agreements and the agreements with the final recipients, and then back the program requirements, the eligibility requirements, and national rules. Then there will be also verification on the specific eligibility rules for financial instruments, and the specific eligibility rules on financial instruments are defined in Article 68 of the CPR. And for example, there will be verifications regarding the payments, the amounts paid, the verifications about the management cost and fees, or checks about the use of interest and other gains, or checks of the eligibility rules in case of an implementation of a financial instrument across consecutive programming periods. And by the closure of the programming period, already Axel mentioned, there will be a verification that what has been requested as eligible expenditure from the Commission does not exceed the total amount of the support paid, so the total amount of the investment.
Lovely, great, thank you, Dana. So let's move. We've got just a very few final questions. So maybe Axel, I can ask you the first one. How do you check potential double funding by financial instruments in the previous programming period?
Thank you, Des. So the idea is not to overdo it. If there is a clear demarcation, well, the body implementing the financial instrument should have, as I said before, a control and monitoring system in place. Of course, this control and monitoring system depends on the risk. And if there is a clear demarcation between the funds and the form of support, the risk is low, especially if from the final recipient, there are some information which is requested, such as a self-declaration or to communicate on the supports they have already received. So the control system should indeed be proportionate to the risk. We don't want to have something which is too complicated if there is low risk. Then when we do our audits, we will indeed check in case of doubts. There are ways to double check, to cross databases to see if indeed the information is correct and we don't have a specific risk.
Thank you, Axel. Next slide, please. Oana, maybe how can you ensure there's no double support for equity operations? Interesting theme here.
So an equity investment means an increase in the capital of the final recipient, the startup, the SME. So if there are several funds going to the same SME, each fund will have to follow its own rules, but it doesn't mean double investment because the purpose of all these funds is to increase the growth of the company and to develop the company. So it is difficult to imagine how it's going to have double funding here. And when you do an equity investment, there is no need to break down the types of investment you will do because you invest into the capital and the company will use this money based on the business plan and the screening of the fund manager and so on. So we consider that the risk is really negligible.
Yeah, I agree. Thank you, Oana. I'll give the camera time to move over to Ieva. And I'll ask the question now. We have the next slide, please. Will private co-financing, Ieva, at the level of final recipients be eligible as a national contribution?
Well, the private co-financing, and here it will probably be a situation of equity investments. It can be eligible and can be counted as national private contribution if the program or individual priority axis where such financial instrument finds itself within the program, if it is based on the total contribution. And these provisions are explained in Article 112 of the CPR. So what is important to remember is that even if the national private co-financing comes at the level of the final recipient, it still has to be checked in a sense that there should be evidence showing the eligibility of the underlying expenditure, which is covered by this private co-financing at the level of the final recipient.
Thank you, Ieva. And the next question, Radka, is to you. Can the eligible requirement, the requirement under Article 58.2 of the CPR, financial instrument investments which do not find sufficient funding from market sources, be complied with on an ex-ante level?
Yes,
Yeah,
yes, because in Article 58.2, when it says that the financial instrument provides support to final recipients for investments which are expected to be viable and do not find sufficient resources from markets, then it is meant to be at the level of a financial instrument. This reasoning and this analysis are not at the level of each individual investment.
That's great. That's very clear. Thank you for that. Can we have the next slide, please? Dana, how will auditors address the implementation of the do no significant harm criteria in financial instruments? Given we're short of time, it's probably unfair to ask you that right now. But yeah.
I will keep it short. So the auditors will look first in the program and then in the funding agreement. To keep it short. Now, if in the program it is indicated that there must be some requirements in terms of the MSH compliance, then those requirements must be transposed in the cascaded down into the funding agreements. Otherwise, nothing has to be done, and the auditors, of course, will not check.
Yeah, no, that's very clear.
In the two documents.
Yeah, no, thank you, Dana. Oana, question about state aid and pari passu rules. How should an audit authority do the verification about the starting position of public bodies and private operators, which I think is one of the requirements under point 87D of the pari passu regulation referenced in the question?
Yes, and it's the first time we see that we take one point by point to assess from the audit perspective. But I think the auditors should check how the managing authority ensured that the operation is pari passu, because when we speak about financial instruments, we speak at the level of the fund. So for loans and guarantees, it's quite easy to ensure the pari passu transaction. And for equity, it will be based on the due diligence. And do not forget that also the fund managers have the skin in the game. So this ensures equal conditions. So the short reply would be based on the assessment of the managing authority and the bodies implementing the financial risk.
Great, thank you, Joanna. Next question for you, Axel, if we can have the next slide, please. Is the Arachne tool for fraud detection suggested to be used?
Well, we commission auditors, we use Arachne, so I can only tell you that we recommend indeed that it should be used. Just to say that we consider the fraud risk in financial instrument to be a lot lower than what we have in under grants, due to the nature of the fact that it is a repayable form of support. Arachne is an interesting tool because it also allows us to have information on the final recipient, and it has access to, it gives information on whether the final recipient, if it is an SME, if it is linked to other companies, etc. So it is an interesting tool, and we use it, and we would recommend the auditors to use it too.
Great, thank you. Dana, this is a question about system audits, maybe, and it's about, is the deadline for system audits of 21 months from approving the program for managing authorities implementing financial instruments for the first time a recommendation, or is it obligatory?
No, in fact, this Article 78 is not about application for the first time of a financial instrument, for example. So the answer would be no. So just a few explanations from my side. This article is about a requirement that the audit authorities will perform a system audit on the newly identified managing authorities or the bodies in charge of the accounting function within 21 months starting from the program approval. Now, it has nothing to do with the fact that we have a managing authority that is not new and that it decides to start implementing financial instruments. So nothing to do this article with the newly. So this article will not be applicable in that case.
That's great. Thank you for clarifying that. Ieva, maybe I can turn to you for the next question. The new financial regulation will include a requirement for the early detection and exclusion system, also in the case of final recipients. And is this problematic?
Well, indeed, as you said, the new financial regulation will extend the requirement to refer to early detection and exclusion system also to the shared management. So member states will have to check this database at the moment of the award of and on the first level whether information in relation to the participants and beneficiaries. So what is important is that the CPR program authorities will have to ensure that the payment application to the Commission does not include any person that is excluded, should be excluded according to this system. But such provisions will not come into force immediately, so such provision will apply only from the 2028.
That's great. Thank you, Ieva. And the very last question, Anna, I give to you. I think it has a very short answer. Can the CPR 2021-27 with respect to financial instruments be applied to a financial instrument declared in the 2014-2020 period and closure?
No, each programming period follows its own rules.
Yeah, indeed. No, thank you very much. Great. that brings us to the end of the questions. So thank you, everybody, and thank you for those who've borne with us, and I apologise for overrunning. I know Jonathan Dennis, the head of the financial instruments unit at DG Regio, is there. John, maybe I can hand over to you just for some final comments.
Thank you, Des, and thank you to all my colleagues for the immense amount of work they've done both on this webinar and the previous one. I think we've done the best part of 5 hours of information transmission, and 5 hours of information transmission takes a lot more than 5 hours to prepare. So thank you very much indeed to all my colleagues. I think this is possibly the end of this stage of the process, that we've been tackling theoretical questions, which, I mean, the very creative financial instruments practitioners are able to come up with, and all sorts of very complex and very difficult questions to answer. But these have been theoretical questions. I think the next stage is when audits actually start to take place, that we will need to address the concrete problems that occur, and we're all available to help out on that. But I think that this has been a very successful first stage in doing a sort of ex-ante question answering. The next stage is answering concrete, real questions that have occurred. Many thanks to all of you who've stayed on so long. We've only lost about 40 people since 4 o'clock, which is good. And finally, many thanks to you, Des, for your expert moderation.
Thank you, John. Yeah, and I would add my thanks to colleagues from the European Commission. Extremely helpful set of responses, which I'm sure are going to be a very valuable resource for people in the future as well. So I add that, and thanks of course to participants who asked the questions in the first place, because yeah, they covered so many wide-ranging topics. That's it. Thank you very much.